In this video, we'll be covering multi-product break-even analysis. Why is cost-volume profit analysis important when a company sells more than one product? In all our past examples, we've assumed that only one product is being produced by a company, but most companies sell multiple products. When more than one product is being sold, the company must consider the impact of the sales mix. Sales mix is the combination of products that make up total sales. For example, a company's sales may be made up of 70% lawnmowers and 30% replacement blades. Sales mix is a term used with regards to the percentage of total sales that each product represents. Sales mix is important because different products have different contribution margins. Remember that contribution margin is the income that contributes to covering both fixed costs and profit. Companies earn more income by selling products with higher contribution margins, and applying the same CVP analysis to a multi-product environment can help companies determine the impact of sales mix on their overall profitability. Let's start by finding the break-even point in a multi-product firm in terms of sales units. We'll use the example of David Inc. The company sells XD2 and has the following information for November. Expected sales, 2,000 units. Unit selling price, $1,100, and variable cost per unit, $730. In addition, the company also sells 500 units of LB4, another product. This product has a selling price of $550 per unit and a variable cost per unit of $330. The total fixed cost, when production of both products is included, is $615,400. How many units of each product should the company produce to break even? Remember, break even is where operating income is equal to zero. There really are multiple variations of how we can calculate this, but I'm going to use the contribution margin approach, modified for a multi-product environment. Recall that the formula for this approach when a company produces one product is as follows. Q, meaning quantity in units, is equal to total fixed costs plus target operating income, all divided by the contribution margin per unit. For a multi-product environment, we have to modify the formula as follows. Q, meaning quantity in units, is equal to the total fixed costs plus the target operating income, all divided by the package contribution margin. What is a package contribution margin? Well, let's figure that out while we solve a step-by-step problem. Step 1 is to determine the sales mix, a measure of the number of units sold for each product. In our example, David Inc. sells 2,000 units of XD2 and 500 units of LB4. The sales mix is therefore 2,000 to 500. However, the sales mix must be reduced to the smallest possible whole number. I start with the original sales mix, 2,000 and 500. Then I divide both amounts by 100, in which case XD2 is 20 and LB4 is 5. However, that's not the smallest possible whole number. I can further reduce this by dividing both sides by 5, so the sales mix will be 4 to 1. This means that every time I sell 1 unit of LB4, I also sell 4 units of XD2. This is my basket of goods, my package. For every 1 unit of LB4 that I sell, I will also sell 4 units of XD2. I can now use this information to calculate my package contribution margin, which is step 2. Using a chart, calculate the package contribution margin. My chart will have 6 columns and 4 rows. The headings will be as follows. Column 1, product. Column 2, per unit selling price. Column 3, per unit variable cost. Column 4, per unit contribution margin. Column 5, sales mix. And column 6, package contribution margin, which is exactly what we're trying to calculate. Using the information from the question, we know that XD2 has a sales price per unit of $1,100 and variable cost per unit of $730. For LB4, unit selling price is $550 and the variable cost per unit is $330. We can now use this information to fill in the chart. XD2 per unit selling price $1,100 and per unit variable cost $730. The per unit contribution margin $1,100 minus $730, which is equal to $370 per unit. We also know the sales mix for XD2, which is 4. So we can place that in the 5th column, sales mix, XD2, 4. Now, in order to calculate the package contribution margin, we have to take the unit contribution margin of $370 and multiply it by the sales mix of 4. $370 multiplied by 4 is equal to $1,480. Perfect. Let's do LB4. Per unit selling price, $550 per unit. Variable costs, $330. $550 minus $330 is equal to the per unit contribution margin of $220. We know the LB4 sales mix. It's 1. So I can place that in the 5th column, sales mix. I then take the per unit contribution margin of $220, multiply it by the sales mix of 1, and that equals the package contribution margin of $220. We have one more thing to do. The package contribution margin is actually equal to the individual amounts from XD2 and LB4, 1,480 plus 220, which is equal to a package contribution margin of $1,700. This is the contribution margin that we earn from selling 4 units of XD2 and 1 unit of LB4. We can now move on to step 3, calculate the break-even point. The formula is as follows. Q, meaning quantity in units, is equal to the total fixed costs plus the target operating income, all divided by the package contribution margin. We know that total fixed costs is equal to $615,400, and we know that the package contribution margin is $1,700. Therefore, we can place these in the formula. So Q is equal to $615,400 plus 0, because we have no target operating income when we calculate break-even, all divided by $1,700. Solving this equation, $615,400 divided by $1,700 is equal to 362 packages. In order to break even, we have to sell 362 packages, and in each package, there must be 4 units of XD2 and 1 unit of LB4. Step 4 is to calculate the number of units per product that we have to sell in order to break even. We know the number of packages we need to sell, but we have to translate that into how many units we have to sell of each product. The formula is total packages multiplied by the sales mix for each product. For XD2, 362 packages multiplied by 4 is equal to 1,448 units. We can also do this for LB4. 362 packages multiplied by 1 is equal to 362 units. So what does this mean? In order for management to break even, they're going to have to sell 1,448 units of XD2 and 362 units of LB4. So we've calculated the number of units of each product required to break even, which is exactly what we set out to do at the beginning of this video. Let's quickly review the steps to calculate the break-even point in a multi-product environment. Step 1 is to determine the sales mix, reducing it to its lowest common denominator. Step 2 is to calculate the package contribution margin using a chart. Step 3 is to calculate the break-even point using our shortcut formula. And step 4 is to calculate the number of units per product that must be sold in order to break even. That's it for calculating the break-even point in units for a company which has multiple products. Note that this process is more complex, but if you follow the steps, you'll be successful regardless of the complexity of the problem. As always, thanks so much for watching.